slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time. Restoring that balance is likely to require a sustained period of below-trend growth. Last year, the ongoing reopening of the economy boosted real GDP growth to a very strong 5.7%. This year, GDP was roughly flat through the first 3 quarters, and indicators point to modest growth this quarter, which seems likely to bring the year in with very modest growth overall. Several factors contributed to this slowing growth, including the waning effects of reopening and of pandemic fiscal support, the global implications of Russia's war against Ukraine, and our policy actions, which tightened financial conditions and are affecting economic activity, particularly in interest-sensitive sectors such as housing. So we can say that demand growth has slowed, and we expect that this growth will need to remain at a slower pace for a sustained period. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into 3 component categories: core goods inflation, housing services inflation, and inflation in core services other than housing. Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex-housing has fluctuated, but shown no clear trend. And I'll discuss each of these items in turn. Early in the pandemic, goods prices began rising rapidly as abnormally strong demand was met by pandemic-hampered supply. Reports from businesses and many indicators suggest that supply chain issues are now easing. Both fuel and non-fuel import prices have fallen in recent months, and indicators of prices paid by manufacturers have moved down. While 12-month core goods inflation remains elevated at 4.6%, it has fallen nearly 3 percentage points from earlier this year. It is far too early to declare goods inflation vanquished, but if current trends continue, goods prices should begin to exert downward pressure on overall inflation in coming months. Housing services inflation measures the rise in the price of all rents and the rise in the rental equivalent cost of owner-occupied housing. Unlike goods inflation, housing services inflation has continued to rise and now stands at 7.1% over the past 12 months. Housing inflation tends to lag other prices around inflation turning points, however, because of the slow rate at which the stock of rental leases turns over. The market rate on new leases is a timelier indicator of where overall housing will go over the next year or so. Measures of 12-month inflation in new leases rose to nearly 20% during the pandemic, but have been falling sharply since about mid-year. As Figure 3 shows, however, overall housing services inflation has continued to rise as existing leases turn over and jump in price to catch up with the higher level of rents for new leases. And this is likely to continue well into next year. But as long as new lease inflation keeps falling, we would expect housing services inflation to begin falling sometime next year. Indeed, a decline in this kind of inflation underlies most forecasts of declining inflation. Finally, we come to core services other than housing, and this spending category covers a wide range of services, from healthcare and education to haircuts and hospitality. This is the largest of our 3 categories, constituting more than half the core PCE index. Thus, this may be the most important category for understanding the future evolution of core inflation. Because wages make up the largest cost in delivering these services, the labor market holds the key to understanding inflation in this category. In the labor market, demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. Thus, another condition we're looking for is the restoration of balance between supply and demand in the labor market. Signs of elevated labor market tightness emerged suddenly in mid-2021. The unemployment rate at the time was much higher than the 3.5% that had prevailed without major signs of tightness before the pandemic. Employment was still millions below its level on the eve of the pandemic, Looking back, we can see that a significant and persistent labor supply shortfall opened up during the pandemic, a shortfall that appears unlikely to fully close significant and persistent. Comparing the current labor force with the Congressional Budget Office's pre-pandemic forecast of labor force growth reveals a current labor force shortfall of roughly 3.5 million people. This shortfall reflects both lower than expected population growth and a lower labor force participation rate. Participation dropped sharply at the onset of the pandemic because of many factors, including sickness, caregiving, and fear of infection. Many forecasters expected that participation would move back up fairly quickly as the pandemic faded. And for workers in their prime working years, it mostly has. Overall participation, however, remains well below pre-pandemic trends. Some of the participation gap reflects workers who are still out of the labor force because they're sick with COVID-19 or continue to suffer lingering symptoms from previous COVID infections or long COVID. But recent research by Fed economists finds that the participation gap is now mostly due to excess retirements, that is, retirements in excess of what would have been expected from population aging alone. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force. What explains these excess retirements? So health issues have surely played a role, as COVID has posed a particularly large threat to the lives and health of the elderly. In addition, many older workers lost their jobs in the early stages of the pandemic when layoffs were historically high. The cost of finding new employment may have appeared particularly large for these workers, given pandemic-related disruptions to the work environment and health concerns. Also, gains in the stock market and rising house prices in the first 2 years of the pandemic contributed to an increase in wealth that likely facilitated early retirement for some people. The data so far do not suggest that excess retirements are likely to unwind because of retirees returning to the labor force. Older workers are still retiring at higher rates, and retirees do not appear to be returning to the labor force in sufficient numbers to meaningfully reduce the total number of excess retirees. So, the second factor contributing to the labor supply shortfall is slower growth in the working age population. The combination of a plunge in net immigration and a surge in deaths during the pandemic probably accounts for about 1.5 million missing workers. Policies to support labor supply are not the domain of the Fed. Our tools work principally on demand. And without advocating any particular policy, however, I will say that policy to support labor force participation could, over time, bring benefits to the workers who join the labor force and support overall economic growth. Such policies would take time to implement and have their effects. For the near term, a moderation of labor demand growth will be required to restore balance to the labor market. Currently, the unemployment rate is at 3.7%, near 50-year lows, and job openings exceed available workers by about 4 million. That is about 1.7 job openings for every person looking for work. So far, we've seen only tentative signs of a moderation in labor demand. With slower GDP growth this year, job gains have stepped down from more than 450,000 per month over the first 7 months of the year to about 290,000 per month over the past 3 months. But this job growth remains far in excess of the pace needed to accommodate population growth over time, about 100,000 per month by many estimates. Job openings have now fallen by about 1.5 million this year, but remain higher than at any time before the pandemic. Wage growth, too, shows only tentative signs of returning to balance. Some measures of wage growth have ticked down recently, but the declines are very modest so far relative to earlier increases and still leave wage growth well above levels consistent with 2% inflation over time. To be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. So let's then sum up this review of economic conditions that we think we need to see to bring inflation down to 2%. Growth in economic activity has slowed to well below its longer-run trend, and this needs to be sustained. Bottlenecks in goods production are easing, and goods price inflation appears to be easing as well, and this too must continue. Housing services inflation will probably keep rising well into next year, but if inflation on new leases continues to fall, we will likely see housing services inflation begin to fall later next year. Finally, the labor market, which is especially important for inflation in core services ex housing, again accounting for more than half of the category, shows only tentative signs of rebalancing, and wage growth remains well above levels that would be consistent with 2% inflation over time. So despite some promising developments, we have a long way to go in restoring price stability. Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy, and I'll close by saying that we will stay the course until the job is done. Thank you.
Okay, we'll see if we get some questions from Jerome Powell now. Let's see what we get here.
To pick between 50 and 75, so I won't have to ask you that. Thank you for your last paragraph. But I want to talk a little bit about wages and inflation. So, as you said, wages are rising faster than is consistent with a 2% inflation rate, assuming reasonable productivity. You said in November that wages are not the principal cause of prices going up. But for many workers, real wages have been falling lately. So I wonder, isn't there room for wages to rise a bit faster so workers can make up lost ground? And what level of wage increases do you think is consistent with a 2% inflation target?
Okay, so I guess I would start by saying that the inflation that we saw at the beginning of this episode back in March of 21 was not really related to wages at all. It was related to tightness in goods markets, largely due to supply chain issues. Over time, though, inflation has now spread broadly through the economy. And while I would still say that the inflation we're seeing now is not principally related to wages, we think that wage increases are probably going to be a very important part of the story going forward, particularly as it relates to that third category of core services ex housing. So we think it is an important thing going forward. And ultimately, in the service sector in particular, where wages and benefits are by far the largest cost, wages need to go up. And of course, we want wages to go up. We want wages to go up strongly, but they've got to go up at a level that is consistent with 2% inflation over time, making basic assumptions about productivity. So if you look at the principal wage measures that we look at, I would say that you're 1.5% or 2% above that with current wage increases. So particularly the employment compensation index and the average hourly earnings index. Look at those two. It's about 1.5% higher than what would be consistent, making various adjustments, including for productivity, from nominal wages. So, and as we look at the labor market today, including today's JOLTS data, what you see is a labor market that there's a real imbalance between supply and demand. There are 1.7 job openings for every unemployed worker, everyone looking for a job. The so-called jobs workers gap is about 4 million, meaning if you look at all of the available jobs, including people who are working, and then look at people who are in the labor force or looking for a job, there's a 4 million shortfall. So you're in that world, and we think that there's a job for moderating demand in there and getting the labor force back into balance.
Hey, Church, we hear you. We'll discuss it together as a family.
You don't think
coming
that
up very
there's a
soon for the
possibility
closing bell.
that we should have a period of catch-up of wage increases above the sustainable level and that businesses with relatively fat profit margins can absorb some of that without passing it through?
So that's the question of the worker share of profits and that kind of thing is not really related to this. Right now, people's wages are being eaten up by inflation. So what you want to do is you want to have inflation stable and then have a very strong labor market where the biggest wage gains are going to the people at the bottom end of the spectrum. And we had that at the end of the very long expansion that ended with the pandemic. That's not what we have now. Now, for most workers, the increases they're getting in wages are being eaten up by inflation. That's actually not true at the bottom end, where wage increases are higher than inflation. And that's a good thing. But if you want to have sustainable, strong labor market, where real wages are going up right across the wage spectrum, especially for people at the lower end, you got to have price stability. And until we restore that, we can't get back to that place where we kind of were for the 2 years before the pandemic hit.
And did you take, when you looked at today's JOLTS data, which measures the vacancies and quit rates, did you find that encouraging?
More or less in line with expectations, but that's
it's going the right direction.
That's a good thing, right? Yeah. So I guess job openings came down by several 100,000 to where they are now, and yeah, that's a positive thing. As you know, the relationship between job openings and unemployment is a very fraught one, and job openings right now compared to unemployment are at near their all-time high levels. So it has been our view that there's a possibility that in this highly unusual situation in the labor market could come back into balance to some extent through a decline in job openings, and that there's been a typical relationship between increasing unemployment and declining job openings, but that our thinking has been, and many labor economists share this, that you could get a decline in job openings that wouldn't produce the same increase a smaller increase in unemployment than is typically the case looking back in history because of the very outsized level of job openings. And we've kind of seen that so far, but it's way too early to say that that'll work.
Traditionally, the Fed looked at the unemployment rate as a measure of labor market tightness, and we've seen recently that may be misleading. Unemployment rate is still very low, and as you pointed out, job vacancies are starting to come down. But to the extent that the Fed still relies on a Phillips curve kind of relationship, going forward, is the natural rate of unemployment a useless concept? What measures will the Fed use to judge labor market slack as we look ahead to policy in the coming years?
So I think the way we think about it, of course, the standard way to think about it is it's the gap between the actual unemployment rate and the natural rate of unemployment that matters, right? And the issue really, it's not that framework doesn't make sense, it does make sense. But the issue is that the natural rate of unemployment is very hard to identify with certainty, even in normal calm times. But when there's a violent disruption of the labor market, it can move very substantially. So, and that happened at the beginning of the pandemic. You had the labor market was very much disrupted, and we assumed that the natural rate had moved up, meaning that for any level of unemployment, the labor market is tighter. So we knew that. And I think what was different in this cycle was really that you had to look at things like job openings and quits and reservation wages and just wages overall to tell you that the natural rate of unemployment had really moved up quite a lot. But I don't think it's a problem with the framework, but it is a fact, though, that it's very hard to pin down where the natural rate of unemployment might be when there's this massive disruption in the labor market going on.
So do you think that the JOLTS data, the job vacancies per unemployed worker, that's going to be a lasting measure of labor market tightness for you at the Fed?
Yes, I think people will tend to look at it.
Well, when you tell them you're looking at it, they tend to look at it.
They'll look at it.
I've noticed that.
That's right. I would just say in this particular situation, we think it's important, and we're going to find out empirically whether that was true for the reasons I explained. We think that we can see a big decline in job openings and less than you would expect of an increase in unemployment. So this was a unique in so many different ways. Right. This series of events was different from one in particular is just that so much of the inflation was due to supply side constraints, right, which is not a feature of the U.S. economy for a long time.
Well, but Vice Chair Lael Brainerd said the other day in a speech that she raised the question of whether long-term changes of the economy, like labor supply, deglobalization, climate change, could reduce the elasticity of supply, and that this may be a problem going forward. Do you share that?
So this is a great set of questions that we've all been thinking about a lot, and Lael's speech was really terrific on that. Augustin Carstens has given a couple of speeches on the same topic, including one at Jackson Hole this year.
The head of the Bank for International Settlements.
Yes, exactly. I mean, the question is, does the new normal going to be unlike this normal that we've had, where supply-side disruptions and constraints were relatively, you could look through them. The lore has been for a long time that you don't need to worry about that, it'll sort itself out. A supply shock from oil prices or whatever. Are we going into a situation a little bit like the 70s, where there will be ongoing repeat shocks, and which would tend to put more upward pressure on inflation over time? We don't really know. I mean, it's a great question. But the question, I guess the real question is, if that's true, what are the implications? We still have a 2% inflation target, and we still have to use our tools to achieve it and to keep inflation expectations anchored. But it's very hard to know. It's very hard to know the answers to these things. I mean, we tend to assume things will go back to the way they were, just naturally, but that doesn't seem to be happening so far.
Right. Now, you mentioned in your remarks that forecasts of inflation have, not only those at the Board of Governors, but in the private sector as well, have been lousy. Inflation has not behaved the way the forecasters said. So I wonder how you think about using forecasts of inflation and making policy. If you can't tell us, or if your staff can't tell you with some degree of confidence what inflation is going to be 6, 12, 18, 24 months out, how do you think about that in deciding when you make policy decisions?
So I'll say that it is very difficult to forecast inflation now, and one of the reasons is just that the situation is so different from the normal one. And as I mentioned, a lot of it is just that the difficulty is just these supply side constraints that we've had. We had no experience in forecasting that. It was, this was a case of first impression. So that was very difficult. Nonetheless, we do make forecasts. We'll continue to make forecasts. The way I tried to get around that in my remarks was to say, let's put the forecasts aside for a second, and let's try to identify the macroeconomic conditions that we think we need to see that would put downward pressure on inflation. So that's a way to think about it. We'll continue to make forecasts, but we're going to have to be humble and skeptical about forecasts, I think, for some time, and that calls for a lot of risk management. And the other difficulty, of course, is that monetary policy works with long and variable lags, in particular inflation is at the end of that train. And so if you're waiting for actual evidence that inflation is coming down, it's very difficult not to over-tighten if that's all you're doing. So we have a risk management balance to strike, and we think that slowing down at this point is a good way to balance the risks of
slowing down on the pace of rate increase.
On the pace of rate hikes.
I see. But it's still a problem if you can't use today's inflation rate to set policy and you're not sure what tomorrow's inflation rate is. You're saying the inflation forecast will be secondary to the economic conditions that you think are likely to generate more or less inflation. Is that basically?
Well, first of all, I'm agreeing that it's a very difficult situation in which to forecast inflation, and really very few professional forecasters have gotten it right. So I think we'll look at various things. We'll look at our forecasts. We'll look at the actual data. We'll look at, I gave you the three pieces and the elements of those three pieces of core inflation that we're looking at. We will, look at these macroeconomic conditions. For example, we will try to identify a level of a stance of policy that's sufficiently restrictive to bring inflation down. We can't identify that with great precision and confidence, but we'll look at the changes in financial conditions and the effects that those financial condition changes are having on the real economy. We'll look at all of those things.
Look at the S&P 500. If we break 4,038, we've broken through.
Well, when you think
the markets will rally further.
About the need to have policy restrictive, and that often is used as the definition of restrictive is above some neutral rate of interest, the one that will prevail when all is calm. And you gave a speech at Jackson Hole a number of years ago pointing out how identifying all these things, the natural rate of unemployment, the natural rate of interest.
Virgin Galactic 503.
The problem is that we don't know what they are. So how will you know when policy is restrictive? How do you think about what the neutral rate is under the current conditions of the economy?
And the answer to that is that there isn't any one perfect summary statistic. So the way I think about it, and I think the way we generally think
Tesla,
about it is
187.
we make our policy changes and they affect financial conditions. Actually, it works the other way around. Financial conditions tighten in expectation now, different from what it used to be. So they tighten. And so we monitor the tightening of financial conditions. We look at the history of these financial conditions index, and we ask how tight are financial conditions. We also look at the effect that tighter financial conditions are having on the real economy, particularly now interest-sensitive spending, but also other things as conditions tighten. We also look. So, what are the financial conditions we look at? We'll look at the entire rate curve. If you think about risk-free Treasury rate curve,
114,
we'll
nearly
look to see
115.
significantly positive real rates across the curve, and you have that. You can argue about the short end, but you've got to pick some sort of a forward-looking reading for inflation. And I think inflation compensation in the markets definitely reflects confidence in us bringing down inflation. So you've got real rates really across the whole yield curve. You also look, though, at credit spreads and what are private companies borrowing at, because most borrowing doesn't happen at the federal funds rate. It happens in many other places. We look at asset prices. We look at exchange rates, which are just another asset price. We look at all those things, and we try to make a judgment about whether put some weight on the real interest rate curve, some weight on the other aspects I talked about. I think you have to make a judgment at the end, though, that you're restrictive.
So an estimate of the neutral rate of interest didn't seem to be one of the big factors in that list you gave?
No, it's in there. It's in there in looking at the real rate curve. So you look at the real rate curve, you'd want real rates to be above what we'd estimate as the longer run neutral rate. Mm-hmm. The issue is, the longer run neutral rate is a rate at a time of full employment and 2% inflation and the economy in perfect equilibrium. That isn't where we are.
Yeah, I noticed. Can I turn to the balance sheet for a minute? I'm going to turn to questions from the audience in a minute. What criteria are you going to use to decide when to end the shrinking of the balance sheet? Is it the economy? Is it whether money markets are functioning well? Is it whether the Treasury is having trouble raising money? How do you decide when you've shrunk enough, when you should end the shrinking?
So I should refer you to a document that lays all this out in detail that I really should be reading to you, but I'll paraphrase it.
Thank you.
If I don't get it exactly right.
No one will pay attention if you don't get it exactly right. Don't worry about it.
Pretty much wing it.
Relax.
So we're in an ample reserves regime, and what that means is that changes in the reserve level will generally not affect the federal funds rate. So there's more than enough reserves in the system. So we're not close to reserve scarcity. So what we said is that we would allow reserves to decline until we're somewhat above the level that we think is consistent with an ample with scarcity.
Right.
And then for a while, what you do is you hold the balance sheet constant, and non-reserve liabilities grow while reserves shrink. So we sort of shrink gradually down to that. And then at a certain point, we're just going to call it. We're not looking to really go back into proving that they're scarce, because what happens is, and you saw this back a few years, the demand for reserves is not stable, and it can move up and down very substantially. So we want to stop at a place that's safe. Having a lot of reserves in the system is really a good thing. It's really a public benefit to have plenty of reserves, plenty of liquidity in the markets and in the banking system and the financial system generally. So that's how we would do it.
In the minutes of the last FOMC meeting, it said the staff had a forecast that it forecasts below potential growth, but not a recession. But then there was this interesting sentence where the staff said the possibility that the economy would enter a recession sometime over the next year is almost as likely as their baseline forecast. Is that how you look at it?
So I have resisted the temptation to handicap it.
Go on.
I think I'll continue to do that. But I get the way I think about it is I do continue to believe that there's a path to a soft or a softish landing. I do believe that, and
the definition of a softish landing is what? Unemployment goes up a little, but we don't have a recession.
Yeah, unemployment goes up, but it's not a hard landing. It's not a severe recession. You can think of unemployment going up, but not really spiking as it does in some recessions. So that's how I think about it. And I think the path is pretty clear. The labor market conditions soften. We see inflation, and the goods inflation gets better, housing services inflation gets better, and the labor market softens but doesn't go into recession, and you see inflation start to come down. And I think that's very plausible. I don't want to be the handicapper on it. And of course, our job is to try to achieve that. Mm-hmm. And I think it's still achievable. Although, if you look at the history, it's not a likely outcome. But I would just say this is a different set of circumstances.
Well, you said at the last press conference that you thought the path to that soft landing had narrowed. Has it continued to narrow, or is it widened? Or I don't know if you can have a wider soft landing, but
I don't know that it's changed since this is what, 5-6 weeks ago. Yeah. I was asked the question, has it narrowed? Is it still possible? And has it narrowed? It's definitely still possible. And it has narrowed because if you look over the course of this year, nobody expected us to raise rates this much. No one expected inflation to be this strong and this persistent and this, to have spread so broadly through the economy. And so to the extent we need to keep rates higher or keep them higher longer, that's going to narrow the path to a soft landing. On the other hand, if we get good inflation data and we get evidence that all the things that I talked about, if all those things start to swing the other way, then we could very much achieve this.
In August 2020, you announced a new framework for monetary policy, the flexible average inflation targeting framework. And I wonder whether there's anything in that you think we should be rethinking now in light of the recent experience.
So we said we would do another framework review in 5 years. And so that would be to bear fruit in 25 or 26. So that's what we're going to do. We're going to stick to that. I think we need to see this through a full cycle. We need to see the other side of inflation and what the economy looks like after this historic episode to really make good judgments about that. I will say, though, that aside from the framework itself, we implemented it through guidance of various kinds. And we put in really strong guidance because there were a lot of doubters that we would ever achieve 2% inflation, if you remember. That was the main criticism. Little did we know. But one piece of guidance that we gave was, and I don't think this had anything to do with or much to do, let's say it that way. It didn't have much to do with all this inflation we're experiencing. But the one piece of guidance that we gave that I probably wouldn't do again is we said we wouldn't lift off until we saw both maximum employment and price stability. And I don't think I would do that again.
Because?
I think it limited it's the tail risk. We tend as human beings to underestimate tail risk, and I think we didn't think it seemed so unlikely. If you remember, 25 years of low inflation,
right,
and many years after the pandemic, after the global financial crisis of inflation everywhere in the world, it's all disinflation. Just didn't seem likely, and yet here we are.
So it turns out that when you invite the chairman of the Federal Reserve to speak at Brookings, a lot of people email you questions. Most
Really?
of them are questions I've already asked or questions that were so poorly framed that I couldn't even understand the question. But somebody asked me this one, and so I want to give that person an opportunity to get an answer. What do you like to do in the morning before you start work?
Work. No, I'm a super early person, and I read a bunch of newspapers and drink my coffee in peace, and then that's what I do.
And now that you're chair, do you still ride your bike to the Fed?
Some. I ride down. Well, I won't tell you where I ride, but I do.
Yeah.
I ride.
The security guys thank you for that.
They're like, no. Yeah.
Okay, so here's the deal. We're going to take questions from the audience. You need to wait for a microphone to get to you because we have a lot of people online. You need to say who you are, and you need to remember that this is not an opportunity for you to make a speech or tell the Fed what it should do. It should be a question. It should be short, and questions end with a question mark. So come down here. Want somebody, Joe, and then Jonathan?
Thank you. Joe Beaulieu from Brevin Howard. So you've spoken both about risk management considerations and the inherent danger of inflation becoming entrenched. So I was wondering, how much do risk management considerations suggest a terminal rate higher than would normally be expected to achieve your policy goals?
So I think there are a number of dimensions, and it wouldn't necessarily, one of them would be potentially a higher rate, but more, I would think, one risk management technique is to go slower, right? To go slower and feel your way a little bit to what we think is the right level. Another is to hold on longer at a high level, and not loosen policy too early. I don't want to over tighten. Certainly, my colleagues and I do not want to over tighten because I think that cutting rates is not something we want to do soon. So that's why we're slowing down, and going to try to find our way to what that right level is. But I mean, theoretically, it's another dimension, but it's not. It wouldn't be my first choice.
Thanks, Jonathan.
Hi, thanks. Yeah, Jonathan Pingle with UBS. So I had a question about the imbalance between labor supply and labor demand. One of the things that's a little obscured when we look at and discuss the labor force participation rate is there is a pronounced downward trend due to population aging. So when you think about realigning labor supply and labor demand, are FOMC officials hoping
keep
or
an eye on the
expecting,
S&P 500
that
bottom right-hand
participation really
corner?
moves back up all the way
If that
to
breaks
pre-COVID
4,038,
peak? And related
we're
to
going
that
a lot
is,
higher.
the follow-on question, how much of the realignment
We'll discuss
do you
all this
think needs
very
to be
shortly.
done through restricting labor demand as opposed to the ability of supply to catch up?
So, on labor force participation, I think it's useful to go back, 10 years, and the forecast that mainstream labor economists had was that, and you're right, aging of the population leads to declining labor force participation. Notwithstanding that, labor force participation was in effect flat and a little bit up from 2013 to 2020, roughly. And that was because you had a strong, tight labor market. People were staying in the labor market longer than expected. That was really what it was. So our ability to predict is not perfect in this, except over long periods of time, you have an aging population, so you're probably going to have declining labor force participation. I don't think it's reasonable to expect that we get all the way back to where we were with labor force participation in 2020 at 63.7, I guess, population adjusted. I don't see that, but I wouldn't rule it out, and we're nowhere near that now. We're a point and a half below that now. So the real question is, do we expect to see big chunks of labor force participation? I got to say, this year we've seen, in the aggregate, not much, and it's been very disappointing and a little bit surprising. So that's part of the story. The other part, as I mentioned, is population. Is that the labor force, a big part of the shortfall in the labor force is actually population as well as participation.
So given population trends, given that there's still some workers are clearly anxious about going to work during COVID, and given that immigration is well below the levels that were projected before the pandemic, does most of the balancing have to come on the demand side?
Well, I think for now, we have to assume that. That's why I talked about, supply side policies on labor, but although they're not for us to recommend or to answer questions about.
Noted, please.
So yeah, the answer is yeah. I mean, that's what I kind of said that in my speech. We have to do what it takes to restore balance in the labor market to get back to 2% inflation, and that's what we're doing. Really, just by slowing job growth, rather than putting people out of work.
Joe Gagnon.
Thank you. Joe Gagnon, Peterson Institute. Chair Powell, back in 2018, you gave a speech questioning the role of the so-called star variables that the Fed uses to navigate. And there was a possibility raised that maybe unemployment could fall well below what the staff thought the natural rate U star was, then without causing inflation. But then COVID came and turned everything around. And as you just said, one interpretation of COVID is that U star went way up and we were on the wrong side of it, which is inflationary. My question is, going forward, do you think it's likely that things could reverse as the dust settles from COVID and we could end up back in that world where maybe we're on the other side of U star, we don't know it, it's hard to tell? What lessons did you learn from that period that got forgotten because of COVID, perhaps?
Well, unemployment went below so what we write down and what the staff writes down is a longer run longer run estimate of the natural rate of unemployment. I guess one thing I would say is that during the course of a long, relatively gradual, so we only have one experience, right, to generalize from, but what I learned from that experience was long, relatively slow, not super fast expansion. You really saw the natural rate of unemployment, the shorter term natural rate, come way down. We had 3.5% unemployment with really little sign. Wages were just getting up to that level of productivity and 2% inflation. So we could be back in that place. I think we could certainly be back in that place. But what we've seen, it's another N=1 situation with the pandemic. It's also unique. I would also point out, though, we did see the inflation we saw at the beginning. We did have natural rate of unemployment go up probably significantly. But again, the original inflation we saw was not to do with the Phillips curve, with the labor Phillips curve. It was not to do with that. It was to do with goods more.
So I think another way to frame Joe's question is, I think a lot of us thought that the lesson we learned when unemployment fell very far and we didn't get inflation, that maybe over time, before you were in charge, the Fed erred on the side of being too tight, that it was too worried about the unemployment rate falling. And I think the concern is that
we will open the
fight the
Discord
last war,
lounge
and because
at
of
the
this
end,
experience,
and you can call
the Fed will
in,
be
have your say,
reluctant to
share your
experiment
thoughts,
with
share
a
your
low
views,
rate of unemployment
and get
in the future.
support from all.
I'd love to have that problem again. If we can get back to,
Okay, so you got like 3 years left in your term. Do you think you can pull this off in the next 3 years so we can run the N=2 experiment?
Absolutely. Yeah.
Claudia Sam?
Claudia Sam Consulting. So the question I had is, we've had unexpectedly fast and large rate increases this year, and that has pushed up the dollar relative to basically any currency in the world. We've seen likely more financial market instabilities. So the Federal Reserve's dual mandate is for the United States, and yet are you worried that a severe global recession or financial market turmoil would come back to make it harder for us to achieve the U.S. dual mandate? Thanks.
So we do, of course, look at global developments. We have a domestic mandate, of course, as every central bank does. But in this world, global financial markets and the global economy really matter for us. So we monitor all that very carefully. We really think, and my colleagues and I really think, that the best thing we can do for ourselves and for the global economy is to get inflation under control as quickly as possible. We don't think the world's going to be a better place our time and inflation becomes, and then we have to go in later. The evidence is that the employment costs of bringing inflation down only rise with delay. So at the same time, we don't want to do any more than we have to do, but we feel like as a risk management matter, we needed to do what we did, and feel like we're now in a place, again, as I said, where we can slow down and try to reach that ultimate level.
But how much do you worry about, I think what Claudia's question implies is, we do something with rates, other people are forced to do things with rates, and that ends up spilling back to us and makes it harder for you to do it. So you have to take that possibility into consideration.
We absolutely believe that we take that into consideration. The model's explicitly taken into consideration. Of course, they're not perfect. No one would say we do it perfectly. But we have a very large global model that we use for the global economy, and it absolutely takes into account what's happening with the real economy and monetary tightening and currency and all those things. It won't be perfect, but we do that. And we also sort of understand generally that there's a lot of research and things. People are talking about this a lot right now, that maybe the whole is bigger than the sum of the parts when it comes to tightening. Maybe it is, maybe it isn't, but we're aware of the risk of that. But again, I come back to look where we are. We've raised 375 basis points. Markets are working. I think we're now in a position where we're in a place where we really can get inflation under control, and unemployment's at 3.7%. So we haven't done. I don't regret getting to where we are, and I think broadly the world will be better off if we can get this over quickly.
Thanks. Julia? Julia, stand up so the mic can find you. And can you bring a mic down here Feroli,
Can I ask two questions?
if they're short.
Yeah, very short. So one question on the labor market is how do you reconcile, the characterization of the labor market as very tight with the fact that wage growth isn't keeping up with inflation and the labor share of GDP really hasn't risen since 2020? And then second question is how much credence or what kind of research do you rely on to think about the notion that a very tight labor market will lead firms to invest in and innovate and become more productive over time? Could that be a tailwind to productivity growth?
Okay, I wrote those down really fast. Now is the problem with reading my handwriting. So
Keep an eye on the
you asked
S&P
about,
500.
Well, the labor market is tight, but
breaks
wages are
38,
not
we're
rising
going
faster
higher.
than inflation.
Okay.
And the labor share of GDP, which has been depressed
Right.
for some time, hasn't really started to rise. So how do you put that into your thinking?
So naturally, we understand that real wages are not going up for most people. But to me, that isn't that's true, but it's not really dispositive. I think the issue really is that it's one of salience, really. So at what point do people start saying, I need higher wages because my real wages are going down. You're giving me these 6% wage increases, but inflation is 7.7%. I need more of that. So we don't really know when that point is. But when you get to that point, you're in serious trouble. And we don't think we're at that point, but it can't be that we can go on for 5 years at very high levels of inflation and that it doesn't work its way into the wage and price setting process pretty quickly. So that's a serious concern. So on the second question, yes, I think we're seeing that. You're seeing the service industries. You're going to see. This labor shortage that we have, as I mentioned, it doesn't look like it's going away anytime soon, and that's absolutely, I think, certain to lead to a lot of investment in technology and labor replacement technology where there isn't labor, and I think you'll see quite a bit of that, and it could be a dividend going down the road. I would think it'll have to be to provide the services that the public wants to buy.
Thanks, Mike Feroli, J.P. Morgan. So you spoke about going somewhat restrictive and then staying there for a long time. Why would you prefer that over a shock and awe approach that goes very restrictive but for a shorter period of time? And I ask that because there's some evidence that sacrifice ratios are lower in a more aggressive regime like that.
I think we've been pretty aggressive, I would say. No, I don't. I don't agree. I mean, we wouldn't, to just raise rates and try to crash the economy and then clean up afterward. I wouldn't take that approach at all. I think we're in a position where the right thing to do is to move really quickly as we have, and now slow down and get to that place where we think we need to be. And by the way, there's high uncertainty around that. We have a broad set of thoughts about where that destination might be, but we could be wrong. It can be higher than that, could even be lower than that. We'll have to see. But I think that's the right approach, and that's also the approach that it would allow us not to throw away the option value of upending a lot of lives, which we would do if we crashed the economy and we might get rid of inflation, but at very high human cost.
There's a question in the very back, a woman in front of the camera. Do you want to stand up? Thanks.
Thank you so much for seeing me in the back here. Nancy Marshall-Genzer from Marketplace. Just wondering, Chair Powell, is the Fed in danger of neglecting its maximum employment mandate? Is the maximum employment mandate taking a back seat to the stable prices or inflation mandate?
No, absolutely not. Absolutely not. The thing is this: without stable prices, we can't have maximum employment, and that's how I think about it, and I think my colleagues as well. In the sense that if you're constantly fighting off inflation and having these battles and having to raise rates, and it goes on for 5 or 10 years as it can, you're not going to have maximum employment. The situation we would love is to have another one of these very long expansions, and we've had 4 of them now in the last several decades. Really, when inflation was low after the 70s, we got out of the habit of these short inflation-driven business cycles, and we were able to reach. You saw where we were 3.5% unemployment Those are really good for, very beneficial to our society to have these long expansions, and the benefits start to go to people at the lower end of the spectrum in the 7th or 8th year in the last cycle. So I think the two things go together. Right now, the labor market is incredibly strong. Again, before this thing, we've never had 1.7 job openings for every unemployed person. So this is a great labor market in that sense. It's too great in a way because it's going to be adding to inflation.
We have time for one more. In the back, gentleman on the aisle. All right, 2 questions. 2 gentlemen on the aisle. Keep them short.
Thank you. I'm Orange Wang from South China Morning Post of Hong Kong. So I would just like to ask a question related with Chinese economy. So right now, a lot of analysts are arguing or believe that China's zero COVID policy is continuing to take a toll on the Chinese economy, but also likely to weigh on the global economy due to the size of China's market and its position in the global supply chain. So we're just wondering about what impact or how much impact do you accept that continuously slowing Chinese economy would have on the U.S. economy or the Fed's next interest rate moves? And is China's current economic situation a disinflationary factor or a inflationary factor to the U.S.? Thanks.
Okay, I guess I just say that to the extent China's having shutdowns in the parts of the country and the parts of the economy that are deeply connected to global supply chains, that's going to make those supply chains less efficient, less effective, and so that will have an effect on, the prices of some of these goods that are manufactured or assembled in China. So it does have an implication for the U.S. It's hard to say how big that will be without knowing how persistent, how long these lockdowns take place for.
And the gentleman behind you.
Thank you. Yevgeny Shego with Public Citizen. I was wondering how you think about the trade-off of restrictive policy and the supply constraints you mentioned. So in particularly when it has a negative effect, say, on housing production that makes it harder to meet housing demand, or on the congressional investment through the Inflation Reduction Act in climate change mitigation and in energy policy that will make energy cheaper long term. How do you think about that trade-off?
Yeah, I don't think our restrictive policy would have much of an effect on the sort of climate mitigation investments you're talking about. In terms of housing, there are 2 things. One, there's sort of a longer run housing shortage that we have. But in the meantime, we had coming out of the pandemic, rates were very low. People
Just taking a very quick
houses.
rest break. If someone could talk on TikTok and YouTube, keep reminding people
and so you really
that
had
I'm
a
on a
housing
rest break.
bubble. You had
Thank
housing
you.
prices going up at very unsustainable levels and overheating and that kind of thing. So now the housing market's going to go through the other side of that and hopefully come out in a better place between supply and demand. But none of this really affects the longer run issue, which is that we've got a built up country and it's hard to get zoning, it's hard to get housing built in sufficient quantities to meet the public's demand.
So I want to thank you, Chair Powell, for being generous with your time, and thank you all for coming in. I want to appreciate everybody asked a short question, which that's the first time in my experience in 8 years in Brookings that's happened. I'd like it for all of you to stay in your seats for a minute till the chairman can leave safely. And if you have paper at the coffee cups or something, take them to the back of the room and dispose of them. So thank you very much.
All right, everybody, you have been listening to Jay Powell, of course, there with David Wessel, there at Brookings, and really some great commentary that has certainly impacted the financial markets. And I've got to say a welcome, good afternoon, everybody. Carol Master, Tim Stenovic. We're not in New York. We're on the West Coast. We've got a special broadcast coming up tomorrow. We are, though, on YouTube and also on Bloomberg Quick Take. But no doubt about it, Tim, this has been the key focal point, if you will, for the week so far. We've got jobs coming on Friday, but we wanted to see how Jay Powell, chair of the Federal Reserve, the most important voice when it comes to monetary policy, what he had to say and how that impacted the markets, and he certainly did.
And it did impact the markets. We're seeing the S&P 500 up close to 2% as we speak. A big word here, Carol, signaling a downshift. That is the big takeaway here.
Do I read that as a pivot? I do read
Do you read that as a pivot?
Well,
it's not a pivot to cutting rates, and he said he doesn't want to cut rates anytime soon.
No.
But going from 75 to 50 basis points, that's a big deal, and the equity markets are loving it.
I thought what was really interesting, too, is what he had to say
Okay,
about...
let's come back out of that now. And thank you very much for covering while I was taking a short break there. They were just saying there that it's a pivot. It's not a pivot. This is absolutely not a pivot. But, well, I rephrase that. It's not a U-turn. It is, however, a pivot. We are going to, and what a U-turn is when rates come down. A pivot is rates still going up, but as I said, it'll come down to a half. And yes, the markets are absolutely exploding. As you can see, I'm up 6.84%. Lot to cover today because a lot of emotions in the chat. I've been hearing what everyone's been saying, very concerned, hearing from church, what's been said, a lot going on, but we're going to address all that now. So first of all, we're going to open up the broadcast lounge. It is now open. The broadcast lounge is now open. This is for YouTube members only. If you look at the bottom of the channel on Discord, only YouTube members will be able to see the broadcast lounge. You can call in. Rates still going up still means slowing economy. Remember, the economy is not the markets. The markets are a different thing altogether. The economy, people getting poor, people losing their jobs, all of that stuff is not the stock market. The stock market is a very, very different place. A very different place indeed. All right, so do not confuse the economy with the stock market. The rich get richer, the poor get poorer. That isn't a bad thing. It sounds horrible, and it is horrible. However, if you want to be a rich person, you got to think like a rich person. All right. Remember, as I've heard here today, how everyone's having a hard time. I have lost everything. I have gone bankrupt. Mike expressed he lost, was it $2 million here? I spent 10 months working for free, sitting here 10 hours a day, investing in myself. If you're going to be rich, you've got to think like a rich person, okay? If you're going to be poor, you'll think like a poor person. That's just the way it is. That's the way the world works. And if you understand the way the world works, you make it to your best advantage. You invest in yourself. I started this portfolio at the worst time in history, but it turned out to be the best time in history. I went all in. I said over and over and over and over again, it's better to put everything in now when we were down like 50, 60, 70, 80% than it would be to do $20 every week for the next 25, 30 years. So I went all in. Now, I have a choice just like everybody else. I've put every single thing on the line. You all understand what I'm saying. I put everything in and some, and some, and some. And I'm taking gigs again. I got offered today a gig every single Saturday, and Leah doesn't want me to do it. She wants me at home, and I'm saying, no, I'm going to work. I'm going to earn the money. I'm going to save. I'm going to invest. And, we're all in the same position. We've all had pain. We've all lost stuff. We've all been unemployed. I've been bankrupt, lost my parents, lost my home, lost my kids, we've all been there. I lost my job when COVID hit. I was having gigs, theatre shows. All of that went down the toilet, right? So what do? You don't worry about what the Fed are doing. You don't worry about what the world is doing. You invest in you, and you stand by what you believe in, and you push forward. But all the time, you're investing in the future. You're always positive. Now, I've been saying now for weeks, and I'm probably the least qualified person on here to talk about finances. Probably. Market profit, way more experience. Many people here, way more experience. But I will not accept that doom and gloom is the future. There's always going to be sunshine at some point. So, I've invested in the best companies in the world, the innovative companies, the companies with innovation. And at some point, At some point, they have to turn up. Well, here it is. And I said that in December, rates would come down. Now, it doesn't mean rates are coming down. They're still increasing rates, but the rate of the increase is coming down. December, it'll be 0.5%. Hey, it may even be 25%. If it is, and I've been saying since day one, my portfolio should be $100,000 by the end of this year. That's 1 month today. 1 month today. I'm at $44,000. That's 66 grand from now until the end of the year. That is completely and utterly doable. That sounds ridiculous. It looks ridiculous, but it really, really isn't. If we get 0.5% or 0.25, people are going to decide to put them, there's plenty of money around, plenty of people with money, they will put their money in the stock market and they'll buy all of this because, look, what I said, remember I said, Meta. Go back and watch my videos. I said Meta was the best investment on the stock market and everybody said I was wrong. I don't think anyone said I think you're right. Not one person. Because everyone was looking at it through negative glasses, looking at Mark Zuckerberg spending too much money, the metaverse, blah, blah, blah. What people want more than anything else is companies to invest in that make profit, that make money. Meta is a cash cow. And all it does is stop spending money, inflation come down, and boom, look at this. The moment the interest rates start coming down, companies are going to invest in advertising again because they see a path upwards. Meta is $200 overnight. $200 overnight. So that there's 6 grand I make overnight with my portfolio. Virgin Galactic, all the rich people that suddenly realize, okay, we're making money on the stock market again. That's the people that are buying the tickets, the ones who are making money on the stock market. They go, right, I've got all this money. Let me sign up for Virgin Galactic. This goes to 10 grand. Oh, this goes to 20 grand overnight from 5 to 10. That's 10 grand. That's now 16 grand. See, my 100 grand is not that far away. Tesla are going to have the best earnings on record. Last month they did, last quarter they did, in January it'll be the same. This will be this could be $250, $300 a share. I put out a video yesterday, worked it out at $333. 333. Right? Just saying. Well, there's another 10 grand. More than that, actually. And the S&P 500, which if we look at the S&P 500, which is the most stable asset you can own, which is down 12% this year, on average 15 to 20% a year, has got that to make up. And it will. It will make up. And what will happen? Boom, 18 grand becomes 36. I know it sounds ridiculous, right? In fact, that probably is a bit ridiculous, actually. That's me getting a bit carried away. It won't be 18, it won't double. That'll be 25 grand. I take that back. I was getting a bit carried away there for a minute. But anyway, that's where I see. And then we start talking about Tilray Brands, which is a $40 stock. That's a 10x. That's 4,000 to 40,000. Just by getting legislation passed. Don't even get me started on Tesco. Inflation comes down. They've said today in the UK inflation is coming down. Tesco, look at Tesco. This is what it does all the time. On dividend days, up and down around here. Look, it's down here. We've got, this could double. There's 4 grand right there. Anyway, the best investment you'll ever make is yourself. I am no different to anyone else. I left home at 16. I had 50 quid in my pocket. My parents didn't have any money. I didn't inherit any money. When my dad died, we had about $5,000 to bury him. That was it. When my mum died, I got a microphone. And the microphone that I got when my mum died is sat right there on that piano. That Neumann microphone was my inheritance from my mum. That's it. That's all the money I've ever had. And apart from sponsors on here, which was the grilling supplies and Melinda's sauce, and for a while, Nudge It, Budget, Move It. They're my only sponsors I've ever had in my life, and I've never been given any money by anybody. So if I can do it, we can all do it. So, Churchy, you've got a family of friends here who are with you every day. That's got to be worth something, church. We're with you every day. We're here supporting you. We're here listening to you. You can say anything. We listen, we talk, we help, we support. That's got to be worth something. Invest in that. Invest in us. Invest in what we're doing here. One thing I can guarantee, and I can see this 100% in my crystal ball. Here's my crystal ball right now. Right, this I guarantee. I'll look into my crystal ball now and tell you one thing I can guarantee. When the rain comes and the clouds come, I guarantee 1,000,000%, as true as eggs are eggs, the next thing that will come will be the sunshine. That is an absolute fact, 100%. And the day it doesn't happen will be the day the world's come to an end, so you won't care anyway. All right? That's an absolute fact, 100%. So let's stop getting in the way of ourselves, because if we're negative, all we do is bring negativity upon ourselves. If we are positive, all we bring upon ourselves is positivity. And you know, you said something about luck, church. You've always had certain luck. Life, luck, fate, I don't know what you want to call it. It always comes along. It always comes along. I am making no effort whatsoever to get gigs. None whatsoever. You know I want to be fully committed to you 100% on YouTube 10 hours a day. I'm not looking to do gigs. Why? Because I can't anymore. I can't because I got my back and I can't. I can't carry gear. What I can do, though, is sit at a piano and sing a few songs. I don't carry gear, no lights, no staging equipment, just walking. I can do that. And I didn't do any marketing or any networking at all. And an agent got my number from someone, and we don't even know where, called me up one day and said, can you do a piano? Can you do me a gig? And I went, yeah. My mate, who's a very wealthy guy, says, Martyn, never say no. Say yes to everything. An opportunity comes your way and grab it. I didn't want to do it. I thought, I work every day in the studio. Do I want to go out in the evening? And I said, yeah. Do you know what happened? I played in that gig and now they keep calling me up. They've just offered me every single Saturday forever, indefinitely. They've just offered me every Saturday. I didn't do anything for that. That just came my way because when I go out, I do my best and I put my audience here first. I don't think about what I need. I just think about what you need. And it comes. Money comes. Stuff comes by magic, like literally magic. Just be positive and it'll all be all right until you're dead. And then it don't matter anyway. All right? Okay. There we go. How's everybody doing? Let's have a look. I've seen you do this a few times, Martyn. You get carried away on a green day. 22. I would only be getting carried away if I'd have bought all these bounces. I haven't bought a single thing going up today. I bought when everything went down to all-time lows 2 days ago. I have not bought a thing. I didn't get excited and go, that's it. It's all brilliant. All right? Sorry, sometimes I don't have people to talk to that can relate or lives like us. Yeah, we've all been there, church. We can all relate to you. The broadcast lounge is open if anybody wants to call in. The market crashes all the time. The stock market always come back in time and will go up higher. Just look at market history. Ever since the beginning of time. I bet on that. One thing I'm going to bet on is human behavior over history. I can't get involved with anything else. This community is worth more than prison stocks. Yeah, there it is. 100% said Mike. 1,000% says Stephen Lewandowski. The Queen is here for you. There you go. The Queen of Logic. We know the Queen of Logic's here for you. Little bit too much, I think. Little bit too much. Anyway, wow, says the Church of Logic. The yes man, always. Always say yeah. What's the point if you say no? Nothing happens. I guarantee if you say no, nothing happens. If you say yes, you open up to possibilities. If I do a gig, I don't know who I'm going to meet. I don't know who's going to want to book me. I don't know who's going to watch my show on Monday morning. I don't know. It's a good philosophy, Martyn. If you don't say yes to things, somebody else gets the luck. Absolutely. There's lots of piano players who want my jobs. I'm telling you that. There's lots of people who want my gigs. That's why we love you, Martyn. Thank you, Baron. Amazing, says the Queen. God is faithful. See, I don't even know about that stuff. I have no idea about that. My wife, Leah, she's religious. She's all about that. God is faithful. I don't know anything about that. I ain't smart enough to know about God or anything else in between, for that matter. No idea. I just focus on me. I don't know about God. I don't know about anything. I ain't got a clue about the rest of it. Carlos, you need to rewind the show. Very powerful show. You need to honestly take my word for it. You know, just take my word for it. Rewind it back. Watch it through. Okay, when you get a chance. Most people who achieve are optimistic always. I guarantee if you're pessimistic, you just have a miserable life. I guarantee that. Guarantee it 100%. Anyway, we're up 5.93. This is not a great day. This is not a great day. We were at 49,000 a week ago. We're down $6,000. We're not. You know, this isn't it. This isn't me going buy. I was at Jim Cramer saying buy. No, it's not that. It's not me saying that at all. I'm already in. I'm looking for the next red day. But now, after Jerome Powell has just said what he said, there isn't going to be an all-time low. I'm not going to get the S&P 500 for 320. I'm not going to get it. I want to buy it at 320. It ain't going to happen. Virgin Galactic ain't going to $4. Yes, tomorrow it could be down to $4.80, but I don't think it's going to $4. Anybody think it's going to $4? No. Is Tesla going to go to $150 now? No, I doubt it. Time to buy on the way up now. Time to buy on the way up now. Time to buy if you're not already in, but not for me. Not for me. My time has come and gone because I'm not buying every month, periodically, over time. I went all in and some, and some, and some. So I am done to reach my 200 grand target. And what will happen now is I need to reduce. I need to start every week putting some money into my buying power or from my earnings from YouTube and the odd gig that I'm going to do. Maybe every Saturday, I don't know. And, oh, by the way, Queen, it's every Saturday. If I take the gig, it's every Saturday in Dallas, by the way. So not far from you. Anybody else in Dallas, by the way. Come along. Anyway, Lucid is up today as well. That's going better. Arrival. They've had a little bit of a bounce. Amazon heading back up to that $100 a share again. Not there yet. Apple up 3.24. I'll never understand these swings. Don't need to understand them, church. I don't understand them either. It just means everybody bought in because they were optimistic. I don't see that's good investing at all. I knew that the inflation had peaked. I knew that the interest rate would slow down. So I'm already in. I didn't buy on the way up. I was already in down here. I didn't buy here. I bought in down here. So I'm just holding now. And as my portfolio gets too big on certain stocks, like $10 on SPCE, I'll start trimming off and just have my profits left in the bank, in the stock, if that makes any sense. Look at defensive stocks. Coca-Cola, I've got an order to buy Coke at $54. There is no chance I'm going to get a $54 Coca-Cola ever again. No chance now. Look, it rises. We had COVID. Boom. It rose. We crashed. Now we're rising. We're not going to see it again. We're not going to see COVID. We're not going to see Coca-Cola at $54. We're not going to see it. It ain't gonna happen. I can't get. That's it now. I'm in. I got $4,000 worth of Coke. That's fine. I'm up 6%. Maybe it'll drop to 5, 4, 3. But I'm not gonna get it for what was it? $54. That time has come and gone. So I'm fully in now. I'm fully in. I'm up 6%. I'm just going to enjoy it going up and take the dividends, reinvest those. J&J is also going up now. Look at that. And what did I say about the stocks that will rise the quickest when it recovers will be the high-tech risk stocks? Google. Everybody sold off Google. Everybody sold off Microsoft. And everybody sold off Meta. And all three of those have bounced the most. Exactly like I said. Because high risk, everyone gets out. And remember, the majority of the money on the stock market is old money. Me and you, us lot here, we're all retail investors with no money. We just started investing. The old money, the real money, the big money, they had shares at a quarter of this price, like Market Profit. Been in it for years. And if you notice, Market Profit's not here again. He's only ever here when it's doom and gloom. So the old money is up so much, they don't even care about a downturn. None of that stuff affected them at all. None of it made any difference to them whatsoever. Me and you, church, and all the rest of us, it hurt us. $4,000 worth of Coke is all I heard. Yeah. I knew when I said it, some smart aleck would come out. All I heard was $4,000 of Coke. Yeah, all right, Mark Corn. All right, we know where you're going. Anyway, so the high-tech stock, the high-risk stocks, and let's remember one thing for a minute. These are the FANGs or the MANGs now. These companies are the best in their field. Microsoft, the best in its field. Meta, the best in social media. Google, the best. I mean, these are the best companies. They got sold because people had made so much money. They didn't need it. They dumped it and they bought things like Coke, J&J, McDonald's, and that's all gone up. Now, that's all going up now. And they know that these stocks are good. They're buying back in again. Everyone comes into the market at different times. And we're getting one hell of a push now. I'm actually up now on Meta. Look, I'm up 1%. Meta is a $200 stock. There it is. Anyway. I want to invite you all now to call in. The broadcast lounge is now open. And what we're going to do is end this broadcast and start our closing bell. Now, you will go directly to the closing bell. It'll take you directly there. All right. But we're going to go to the closing bell. So if you're watching right now, here is the closing bell for you. Let me just open it up a second. I didn't have it open. I'm on a completely different screen. You may have noticed I rushed in a bit late today. Did anybody notice that? Did anybody notice I just kind of burst in halfway through the halfway through? Anyway, so we're going to end this broadcast and we're going to go to the closing bell, which is this video here. It's all in order. It will. If you stay where you are right now, it'll just come directly to it. But here is the closing bell. Let me give everyone this. Go over there right now. I want to end this broadcast. Go to the closing bell and let's get everybody in. Okay, there it is. I'll post it 3 times. So I will end this broadcast right now. And we'll join each other up again in a couple of minutes. And I want you to call in and be part of the show. We've also going to have Day Trader of the Day and see how all this ends up. I said by the end of the year I should be at $100,000. I still stand by that. Right, I'll see you all back in a couple of minutes. We won't do the credits because we want to switch from one show to another. All right, I'll be there. You can go over there now, get in the live chat. I'll be there. All right, guys. Thanks for all being with me through Jerome Powell's speech. And it was no surprises. I said it would be muted, and it is muted. 6% up today, when we lost that a few days earlier, is muted. I said he hasn't got much to say. We all knew. Well, I did anyway. I think most of us agreed that the rates would come down to 0.5%, maybe 2.25 even in December. That's all expected. So it's exactly as expected. Anyway, see you back in a couple of minutes, live here once again. And I don't want to live out of my car again. Church of Logic, that's not going to happen. That's only going to happen if you think it's going to happen. It's not going to happen if you don't think it's going to happen, right? All right, mate. See you back in 2 minutes. Don't go away. Between now and then, take care of yourselves and each other.